Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katsimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State region. One day the market's up 700, one day it's down 700. Who the hell knows what the hell is going on with the market? And this market is having a major effect on the real estate market in the country and in our region. So today I've assembled 4 distinguished citizens who will tell us about what their thoughts about the market and the real estate market and business in general. My guests today include Rick Lyons, the Executive Vice President for all commercial real estate for Capital One Bank, David Kramer, a principal at the Hudson Companies, David Sterling, the Chairman of the Board and CEO of Sterling & Sterling, and last but not least, a good friend and a person who's been here a number of times, Robert Ivanhoe, the Chair of the National Real Estate Practice for Greenberg Traurig. So, Rob, you and I go back probably the longest over the years, and I remember you at least over 20 years, maybe 25. So. What do you see this market today? I mean, what's really happening? I mean, you represent people like Tishman Speyer, Apollo, other funds. What do you see, what's going on today?
Well, I think nobody knows exactly where the market is, and you described some of the emotions in the stock market. Well, a lot of that has spilled over into the real estate market. There were concerns about underlying fundamentals. A while ago, when the market started to get a little bit questionable, people said, well, the underlying real estate fundamentals are still strong. And supply and demand and leasing for office, retail, and all of that, even residential for multifamily, the fundamentals are still strong. Well, I don't think they've deteriorated much, but as we start to ease into a recession, they're clearly on the decline, and I think they'll continue to decline. And when you combine that with the credit crisis, I think a lot of people are just waiting to see what's going to happen, and they're sitting on the side. Even people with a lot of capital are sitting on the sidelines right now.
So what has happened? How does a lender, who lends all over the country in certain markets, how do you look at this? How do you make a decision on what you want to put money at? I mean, because Capital One is a strong company. Yeah. We joke that it's the credit card company. We don't have those little cards over here, but
we do a lot more.
Okay, than I know you do. That's right. The Capital One Bank. How do you make that decision today?
Well, I mean, that's a great question. And to Rob's point, I mean, I don't think anyone knows where values are today. Are they down 20%, 10%, 15%? what we are doing is looking solely at cash flow. So if you look at in-place NOI and you underwrite to sound fundamentals on that, as opposed to trying to determine what the cap rate is.
So, but let's look at it this way. When you're looking at in-place cash flow, and David is a developer, and when he's building a condo, he's figuring something. You don't have an in-place. You don't really know what the market's truly going to be. Huh?
And there's not a lot of construction happening right now because no one knows where to go in the face of this storm.
Actually, it's that there's plenty of construction going on that's in the pipeline.
It's in the pipeline.
There's no construction lending going on now.
Right.
And to answer your question to the banker about how banks make decisions, in this period, the answer is the banks have made a decision. I don't have
a coin over here. Do I flip?
They don't even. They put the coin in their drawer and they say, call me in a couple months. And basically, the decision the banks have made with new construction lending is to basically sit on the sidelines and wait this out and not take any risk in anticipation of potential bad things happening.
Now, I would say that most banks are doing that. Not all. I have 2 or 3 construction loans that I've just done in the last 60 days. Very good clients, people like the Hudson companies, people I know that can build it, deliver it, get it done. We're a little more conservative. Equity's critical. Recourse or some form or fashion of recourse is required. And we're picking and choosing very carefully on not only the project, but really the sponsor.
So, David, what effect, we were talking prior to the show about insurance premiums. What's happening with insurance companies?
Well, right now it's all good news for developers and owners because there's a price war in the insurance industry, especially in the real estate and construction areas. And that's a function of the fact that the insurance companies, since 2002, built up massive amounts of surplus. And in order to deploy that surplus, they have to write premiums, and they compete with each other. The real question is what is truly the value of that surplus today? And I think that some of the insurance companies are looking at that and getting answers they don't like, and they're shoring up their balance sheets. It's a question of how long this price war will last.
But let's look at it this way. The price war, the government basically took over AIG. I mean, they own 80% of AIG. And David and I know of certain people where AIG is a lender, an equity player in a transaction. So when, some of these loans aren't going to work out. So what happens to an insurance company like an AIG if they take these major losses? And what happens with these other insurance companies who lend? I mean, Rob over the years has represented a lot of insurance companies as their counsel. How if they get some bad loans, that's going to cut their surplus and
Sure it is.
And that's the insurance company's version of deleveraging, if you think about it. Because what happens is if their capital base shrinks, they can write less premium. So if one insurance company shrinks their surplus by 25% and they have to reduce premiums by 25%, where are those customers going to go? So if all the companies are doing it once, then they only have a certain amount of insurance to write, so they're going to start getting higher prices for the amount of insurance they can write. And that's essentially what we're talking about going on in the lending industry. The banks have only there's less leverage. There's a certain amount of capital to deploy. They're going to get the highest rate they can for what they've got available. The other part of it is, as David was saying, nobody's really sure what the value is. So there's a certain amount of risk involved in
yes, David.
Let me give you an example. We have a we have a construction, a new development site in Clinton Hill, Brooklyn, across from the Pratt Bookstore, in an area that's a perfect type of neighborhood for what Hudson does, which is that we go into transitional neighborhoods that are in the upswing. We were in the meat market 12 years ago, in the East Village 15 years ago.
Emerging urban market, what do you call it?
Emerging urban market, sounds good. Gowanus, Dumbo. So we have this great site in Clinton Hill. We're partnered with the owner, so we're going out for financing for primarily hard and soft costs. If this were 2 or 3 or 4 or 5 years ago, we would have had multiple offers to finance just the hard and soft costs, because we're basically using the land value as equity. And what that creates is a very low break-even for the bank debt. In this case of Clinton Hill, it's under $500 a foot. So we felt very comfortable.
That's cost.
What's that?
That's cost.
That's cost.
So,
That's
but
debt.
cost. But you have to. So if it cost you $500, what were you planning to sell it for?
$700.
Okay.
And okay, so the market has softened. There are issues with end loans. There's concerns about the future. So maybe it's not 700. But we went out for a $500 a foot construction loan, thinking we would get multiple lenders lining up. I think it equates to about $40 million. And not only did nobody pick up the phone, but when we did talk to lenders, yeah, maybe I'll give you 28, maybe I'll give you 24. By the time you had your second conversation with them, it was down to 22. And when I said, well, that's the equivalent of $250, $275 a square foot break even for a condominium. Isn't that awfully conservative? Well, we're not lending on condos. We're just looking at as the rental value. Well, isn't there a value for
David,
condos?
maybe you were spoiled during those other days. I mean, somebody calls me up and they said, I have this hotel site on 34th Street and 10th Avenue.
Yeah.
It's a great site on 34th and 10th Avenue. I said, yeah, if I'm near the convention center, it's really a great site. And he said, my basis is like $300 a square foot. I said, and what's it going to cost you to put the keys and everything? Oh, it's about $500,000. I said, there's nobody going to lend you money. He said, so what can I sell the land? I said, we are in October of 2008. We are in a recession. I don't care what it says. I have to follow Mr. Ficalora's comment. We're in a recession. The land that was worth something at that time is not worth what it is today. And it's a question of denial.
Yeah, I mean, I think that one of the dynamics in the real estate world today is that the gears have just seized up on transactions, and there is a spread between the bid and ask at every level, between the seller and the buyer, between the developer and the landowner, between the borrower and the lender, and you see it, all throughout the process. I mean, we were scratching our heads thinking that for a decent site in Brooklyn today, we would pay $50 a foot for land. Now, $50 a foot for land sounds dirt cheap when land was trading at $175 to $200. But when you factor in the perfect storm of construction costs still haven't softened, financing is very difficult, the 421A tax exemption has gone away, and you have to worry a bit down the line about condominium values, you get a $50 foot number.
See,
or
but
at least
you said the word condo. That word has left the dictionary. I mean,
the lending dictionary.
It's left the lending dictionary. Rob, it's left the legal dictionary. Now, what happens when somebody comes to you as a consigliere, as the counselor, and what do you say to them when they say, maybe I want to develop a condo? I mean, what are you seeing? I mean, because a number of your clients, or as one would say, waiting for the knife to fall. They don't know when to pull the trigger. You represent funds. David represents funds.
Condos have obviously been a huge problem, and we've seen these problems develop over the last couple of years in many different phases of the development. Even ones that are getting finished, there's a concern about, will the lenders of the end loans close? Will buyers close? Are they concerned that values have gone down so much that they'll walk away from their deposits? Maybe we had some closings where some people who were buying lost their jobs, so all of a sudden they lost their end loans. It's a very different world. We have a lot of construction projects that are in mid-course construction right now, where the loans are very much out of balance, and where lenders might have been a little bit more forgiving about covering the rebalancing themselves. Uniformly today, the lenders are saying, I want the borrower to rebalance, and until it's rebalanced, I'm shutting the job down, no more funding. There are a lot of places where condos, I think lenders in particular, are much more nervous than probably any other product type.
Yeah, I was going to say, we were talking about your Clinton Hill, and earlier we were talking off camera about the recession. Has it hit, and has it not hit? But one thing I can tell you for sure, for the last 2 years, outside of New York, I've got clients that are funds that have lent money to a number of projects, Boston, DC, certainly Florida, where none of these condos are sold, or very few have, and they're converting these projects into rentals. And so what was interesting, one particular fund had a strategy that was their plan B, so that they knew that the worst case scenario, they'd end up with if they loaned to it, they could take it back and they could operate as a rental. So if the rental market return, or the difference in the value of a project as a rental versus a condo, is the difference between $275 a foot and $650. I suspect it's closer. I think they were being ultra conservative. But if it is that different, I think that also speaks to.
But you see, I think Rick, which I would throw the question.
Right. Perfect. That's a perfect lead into this.
Right.
I mean, we have for a long time underwritten as a rental fallback. So maybe it's 80% loan to value instead of our 70% or whatever we like on that. But we try to underwrite to that. In 2004, 5, and 6. Prices of land got out of control, and it was very hard to underwrite condos to rentals. Right. We didn't do so many condos then, and we did little ones in Brooklyn, and we did some, we did some. But now that's, so we come back to you and we say, well, I don't think the spread's that high, but absolutely, because all the upside for condos, that's your profit. I need to be covered. I'm only getting a 2% or 2.5% spread. I can't take that risk. I can't take equity risk with senior debt dollars and deposits.
But here's the question. David, you have a really great project in Roosevelt Island, Riverwalk, and I think the size of your units are small units, even though they're a condo, but they're smaller units. So a 1-bedroom may be 600 square feet, 2-bedroom could be 800 to 900 square feet to 1,000 square feet. Many of these condos that were built, the 1-bedroom was 800 square feet, or a 2-bedroom was 1,200 square feet. So the rental fallback that you spoke about is not realistic because you can't get the dollar square foot rent. I mean, if you had to go on a rental fallback, in which you even did it on one of the Riverwalk before, it was good because you were able to get that rent.
Yeah, that's right. I mean, you have a different product type for condos and rentals. So when you do the fallback, you're going to take a hit on the rent per square foot, depending upon what the unit type was.
Right, and the finishes and all that, condo finishes versus apartment finishes. But we're seeing that today. I mean, some of our clients are coming to us and they've sold 30% of their building or 40% and sales have stopped. And we're working with them to say, okay, how does the rental fallback look? We'll give you time, you work with us, and we'll be able to say, because they don't want to give up. If you bought a piece of ground in Park Slope, do you want to give it away today? Because you know that you think the values are going to come back in a couple of years.
Those projects are tricky because at some point the end loans are not going to give those 30% buyers the mortgages to move into a building that's only 30%
and I think for my viewers this is very important.
And I think the buyers don't want to move into a
that's the problem.
rental
When
building.
somebody is buying
That's just happening in Florida.
Okay, somebody's buying a condo in a building. They want to be there with condo owners. They don't want it to be transient.
Oh, but I think I live in a condo building that has rental apartment, where condo owners are renting the apartments. So there are rental units.
I think you'd rather have renters in an empty building.
Yes. Florida may be different. I think New York, everybody mingles together.
Let's get a little bit off because we really been talking a lot about the residential. What do we see happening in the office market?
You're talking investment sales or leasing?
I'm talking about investment sales and leasing, and I think prior to the show we were getting to the situation that we were saying, there were people, many of them could have been Rob's clients or somebody else's clients or David's clients, who bought a building because everything was going up. I mean, it was, the prices were no option, and I'm going to get $80 now, I'm going to get $95 next year, I'm going to get $140 over there, including the building that you're in. I think that's a great example. When Tishman Speyer bought the MetLife building, there were rents. And I remember my friend Rob Ivanhoe saying, I need some more space. And what did you do? You moved part of your office to Westchester because the rent that they needed.
The rents had gone up so much. We weren't prepared to lease space at over $100 a foot.
Right. But today, we'd
rather wait and lock in for 15 or 20 years at a lower number, not at $100.
So what's happening today? I mean, what happens to a borrower? Who has this situation? The fuel oil, even though oil has gone down, the fuel expenses have gone up. Fortunately, the insurance premiums have gone down. But where is this?
Yeah, there are a lot.
I was just going to say, I think you have different scenarios in the office market. You have a number of very strong, deep-pocketed owners that have a low basis and they can wait it out, and they're not going to drop their rents. They're not going to panic. And Sheldon Solo made the story famous in the 1970s when he sat there with a vacant building and wouldn't give away the rents, and he held out and leased the building up at numbers that nobody ever thought he'd get, and he made a gamble in doing that paid off. And I think people who have deep pockets and a low basis will do that, and they won't give it away. The real problem is that from 85 to 87, when the underwriting standards changed and underwriting for debt was based upon pro forma projections rather than in-place NOI, and the lenders were, the Wall Street lenders and some of the others were beating each other to a pulp to compete for every piece of business that came their way. You'd see 85 to 95% leverage deals in the capital stack based upon pro forma numbers that are never to be achieved. So in those loans, they have huge interest reserves to carry them for a while. And when those interest reserves are eaten up, or when those loans mature, you're going to have maturity defaults, I think, all over the place, starting in 2010, when the 2005 loan becomes due. So 2010 to 2012, I think we're going to have a lot of maturity defaults, and sooner when interest reserves are used up on some of those properties. And if you don't have a deep-pocketed owner, or you have an owner who has so little money invested because it's so leveraged, they may let go of it.
What happens with these buildings? I mean, this is not, I remember, Rob, in the 90s when people were taking back buildings, nobody knew what to do with that. I mean, we don't have the same situation, but we do have a problem because there were people who put next to nothing in it. They went non-recourse, they could give the keys back, and they
I think that there's going to be a massive restructuring. The interesting thing is those loans aren't sitting, and if I represent many of the portfolio lending banks, aren't sitting in our banks. They're all in your pension fund, in your 401k, and all in securitizations. So nobody wants to take those properties back. Nobody knows what to do with it. There's also happens to be an awful lot of equity. This is not an equity crisis. This is a lending crisis. Equity sitting on the sideline, and when you have a building for $100 and it goes down to 80 and your loan was 80, what's going to happen, I think, is equity is going to come in and be able to put something together to carry that, because you're probably only going to get a 50 loan on that, or 60 loan, and you'll end up bringing more equity in, and there'll be good opportunities for equity.
But there isn't enough equity to do all that. So in order to raise the equity, people are going to have to sell off assets, and that's going to put downward pressure on the
There's not enough equity, perhaps, in some of the owners, but there are equity sitting out in funds.
There are tremendous.
The vultures are out there.
Right.
Okay, they're just waiting for the prey to go in there. The vultures are there.
Yeah, from what I hear from brokers, their phones are ringing off the hook with prospective investors just waiting to buy distressed real estate, right. And it's not distressed yet. There continues to be spreads between bids and asks. The deals haven't happened yet
because it's interest reserve. When that runs out,
then it'll be a different story. Then it'll force things to happen.
And there's enough lease turnover as well. Right. That also going to put pressure.
But as a non-commercial real estate person, I think that part of your question is like, what's the future of New York City? How healthy is this local
please,
economy going to be?
I've been running too many panels and other things where people are. New York City is 5 boroughs. Manhattan. Let's talk about the other boroughs. And we were talking part of the show with Rick. Jersey has been in terrible shape. The office market in New Jersey has been in the crapper for at least the last 5 years.
Most of my lifetime. No, I mean, but
I mean, with the exception of Hoboken,
right.
With the exception of Hoboken, Jersey City.
There's Parsippany and there's different places. What you don't have is a lot of run-up in value. So if you can get it in at the land at the right basis, and the cost is lower than New York.
But let's get to this situation, and you have clients over there. Yeah. What happens right now to Jersey City and Hoboken?
Well, see, I don't think that's where the CMBS and the over-leverage was. The real CMBS is in San Francisco, Chicago, New York, and Boston. And that's where you're going to have the over-leverage. Other properties are going to be stressed simply with a recession.
What about with a projected unemployment of 165,000 people? What effect people are some of these people would go to Jersey City because it was less expensive for the office space. Certain people would buy in Jersey City or rent in Jersey City an apartment because it was cheaper. Maybe they can go to Roosevelt Island and buy an apartment now for less, or they can go to Washington Heights, or they can go somewhere else. What effect is this going to have on the other sections of the region? And you're in Long Island, where it's been terrible anyway. The office market is limited, but nothing really moves.
Well, actually, what's crazy about the Long Island office market is that I have to disagree with you. I think it's pretty strong. I mean, there's There's we live in our office is in a CLK Houlihan Barnes park, and there's just not a lot of space there, and they're getting nice rents for it.
They're getting nice rents, but you know, it's a certain level. It's like Jersey. They stay at a certain level. They're not going to
25, $30 a foot.
Yeah, and it stays steady, and it's a good office market. Jersey's a good office market. Long Island's a good office market
probably.
Until you overextend. And I don't think people in Long Island hasn't had a lot of new construction.
No, there hasn't.
And neither has
Supply.
Jersey right now. So they're sort of stable. The thing about New York, which I like right now, is that we've only added about, well, actually we're down about 5 or 6 million square feet.
Right, if you take into the loss at the World Trade Center.
So we've added
And
8%
conversions, right.
jobs each year over the last 3 or 4 years, and we haven't added to the stock. So we don't have an oversupply. In the 90s, we had a big oversupply issue because the banks lent crazy on the construction.
That's a
But
saving
Michael's
grace.
question
That's a
is
saving
when the 165,000 jobs are lost, and if we move into a stronger recession. But what's going to happen to the outer boroughs? And I think the answer is pretty easy. When you have a tremendous diverse range in rents, if you're getting $20 a foot in nice parts of Brooklyn, and you're getting $100 a foot in nice parts of Manhattan, and you know people will be moving to Brooklyn. But if all of a sudden there's such a crush in Manhattan and that 100 falls to 40 or 50 or 30, you're going to start really stealing from all the boroughs.
I'm going to throw a question because I know where Rob lives. You live in Greenwich, right?
Right.
Hedge fund country of the world. What's
Right.
going to happen with these hedge funds who have lost their value, who paid these high rents? What's going to happen to the office market in Greenwich?
Well, I think it depends on how deep the problem gets in the hedge fund world. If a lot of Greenwich hedge fund, I mean, Greenwich rents in the last 7 or 8 years have been unbelievable. I mean, they're probably $30 or $40 a foot. 6, 7 years ago, now they're well over $100 a foot, $150 a foot. They're as high as the highest New York City rents. And these are buildings, this isn't a 9 West 57th Street or GM building, quality building that I'm talking about up there that gets these numbers. But it's a very small market. So if all of a sudden the demand shrivels because a lot of hedge funds blow up or close down and with redemptions and shutting down, the market will change pretty quickly.
So, you know, in conclusion, I could say, you know, with the crazy stock market, with the way we are, and with the recession, we have a long time before we were saying we were in certain innings in certain areas, but I think we're at the early innings in a lot of the respects of the world. I'd like to thank Rick Lyon, David Kramer, David Sterling, and Rob Ivanhoe. Next week, perfect answer to the thing. I have office guys going to say what's happening in the office market. See you next week.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.